Hi, my name is Arish Nurani. I am a certified financial planner and wealth advisor here at BGA Wealth. And today I'm joined by Jeff Cohn, our CFA charter holder and chief investment officer here at BGA Wealth and Beam Wealth Advisors. And this is our Map Your Money podcast.
Hello and welcome to the Map Your Money podcast, a production of BGA Teams. We exist to simplify the lives of our clients and listeners and help you lay the course to meet your financial goals. Content is for educational purposes only. Consult a financial advisor or conduct your own due diligence of investing. Calls are pre-screened and the show was pre-recorded earlier this week.
All right, Jeff. So 2024, it's a new year. Happy New Year to you.
Yeah, Happy New Year. Wow, a new year already. Who knows when the next one's going to come around?
I would say 365 days, but it's a leap year though, right?
Ooh, yeah, it is. Yeah, nice catch. Nice catch.
Oh, yeah. Well, new year, we're trying to switch up the format of the podcast a little bit. So new year, new podcast a little bit. We're basically putting together a docket that we're going to run through, putting in interesting graphs, articles, charts, things that we see throughout the month. And then just kind of talking about them and seeing our different perspectives, my perspective as a wealth advisor and a financial advisor working with clients. And Jeff, I know your perspective as the asset manager and the chief investment officer. So it's going to be great to kind of bounce ideas off of one another.
Yeah, I'm excited for this new format. Excited to hopefully try to surprise you with some topics and some interesting graphs for us to talk about. But yeah, I think we have some good things lined up for today. So what do we got?
Sounds good. Well, before we jump into that, I know we've historically just done an icebreaker to start every episode, and I don't have a specific icebreaker in general, but I know that this episode's probably going to come out right around the time of the Super Bowl. So I figure why not make ourselves sound dumb to start off and give our Super Bowl predictions. So we're recording before the playoffs. So what are your two teams you expect to see in the Super Bowl, Jeff?
Yeah. I mean, playoffs are set. My girlfriend is a huge Browns fan, but obviously I'm not going to choose the Browns, even though I do live in Columbus, Ohio, and there's a lot of Browns fans here. So it's tough to write off the Niners. I think they've looked good all year for the NFC. And then the AFC, man, the Ravens have really looked good. And it's really hard to write off the Chiefs, though. They kind of have that struggling wide receiver set, and which has really plagued them this year. But I think they're always kind of a team to gun for. If there's any team I don't want to see make it, it's the Buffalo Bills, because Josh Allen is just the bane of my existence. So hopefully they get knocked out first round.
Yeah, I know the Bills had a rocky season, but have now ended up landing the 3 seed or the 2 seed. I think it's the 3 seed, but they have a home playoff game regardless. So I want to see a Chiefs-Bills rematch at some point in the AFC playoffs, but I guess I'd say Ravens-Niners looking like the most likely. But it'll be interesting to see how it plays out. I feel like it's pretty open. Yeah,
it's for like a Cinderella team that I would love to see win, but not necessarily predicting to win, is the Detroit Lions. Number one, I think it would be their first Super Bowl in history. I guess that would also be true for the Browns.
Yeah.
And the Texans. Wow, there's a few teams that are in there that can win it for the first time. But actually, really cool guy at a bar that I go watch football at sometimes named Riley, who's a huge Lions fan, put in a bet a year ago that the Lions were going to win their division and the Super Bowl. And we all kind of laughed about it, like when he told us about it a year ago. And now looking at it, it's like, man, I hope you win that bet, dude. Like, I hope
there you go.
And I hope you didn't put too much on it.
Yeah. As a financial podcast, I think we need to say bet responsibly if it is legal in your state. But
yeah, I think I told him like, hey man, you should have bought some NVIDIA, but that's all right.
There you go. Yeah. Slightly better investment, but hey, there's some good returns out there. If the Lions win, that'll be a hard one to beat
for sure.
But I guess that's a good segue, kind of going into our finance theme, of course. Before we kind of jump into economy market, I know our last episode we were reviewing 2023, and so a big purpose of this call is forecasting 2024, what we see, what the market's seeing, and everything like that. But want to talk financial planning really quickly before we jump into all of that. And so my main point to make here is just the changes that happen each year. And so every year the IRS comes in and they changed the contribution limits, the income provisions, the deductibility income rules for all of the contributions for retirement accounts. And so I'm going to quickly go over those. It might just sound like a bunch of random numbers to you, but the big important takeaway here is that if you are contributing to one of these accounts or have been contributing on a monthly basis, to make sure that if you were maxing this out, that you're still maxing this out, you increase your contributions for 2024 if needed. And so the IRA contribution for both your Roth IRA, your traditional IRA, or your SEP IRA increased to $7,000 for 2024. And then the catch-up is still another $1,000. That catch-up is for individuals above 50. So combined, able to contribute up to $8,000 in 2024. And you have until the tax filing deadline of the following year, so until 2025, to make those contributions. So if you haven't made your 2023 contribution, you still have up until the tax filing deadline in April to make that contribution, which I think is important. 401k increased by $500 up to $23,000 per year, with an additional catch-up of $7,500. So in total, with the catch-up above 50, able to contribute $30,500 into the 401k. I'm not going to go through every single account. I know that wouldn't really stick in everyone's brains, but the HSA contributions also went up, as well as simple IRA. If either of those are applicable to you, I'd make sure to look those up and make sure you're still maxing that out. And as well as the Roth IRA income limits. I believe it was $218,000 for married filing jointly last year, or for 2023, that's up to $230,000, and those windows increase, as well as the IRA deductibility. Main thing here is if you were contributing to one of these accounts, make sure that you're still maxing that out if you're monthly contributing. I think that's important and something that can be missed, and might seem like a few dollars extra each month, but it will go a long way in the long run. But I guess kind of back to the main grunt of what we wanted to talk about in terms of the market, the economy, and so expectations for 2024. I guess a good place to start, Jeff, is I know we spent a lot of time talking about inflation, talking about higher interest rates that we've seen. I think interest rates is going to be the main talking point here for 2024. And so what are sort of the expectations for 24 in terms of what we're going to see with an interest rate cut?
Yeah. Interest rates have been the talk of the tape for a few years now. You know, they bottomed out in 2020 during the pandemic, and then they've been rising since late 2021 and into 2022, which caused a big market meltdown. And you know, we've been talking on this podcast quite a bit about how rates have to eventually normalize, right? And right now, I think if you look at where interest rate levels are, especially over the last few months, interest rates are probably higher than they need to be. And a lot of us recognize that. A lot of us recognize that, hey, 5%, or 4 to 5% on the 10-year, 7-8% 30-year mortgage rates. It's really tough for the economy to grow at these interest rate levels, and the economy is showing signs not of recession, but really just of normalized slowing. And so we would expect interest rates to continue to come down. And hey, what do you know? That's also what the Fed is expecting too. If you look at the Fed's summary of economic projections, this is a table of different things that each Fed member puts out every other Fed meeting. So Fed meets every 8 weeks. So every other meeting, they put out a new summary of economic projections. And overall, they expect the Fed funds rate to go from 5.4%, which is around where it is now, to 4.6%. So overall, they're expecting 3 different rate cuts of 25 basis points each by the end of next year, where the Fed funds rate will go down to 4.6, which, by the way, would still be a lot higher than it's been over the last 10, 20 years.
Yeah, and so that 4.6% that they're projecting, that's by the end of the year, 12/31.
That's by the end of the year.
Okay.
Yeah.
Okay.
Yeah. That's always the way they project. And what's funny is we were talking about this a few months ago, but when they last released their summary of economic projections, which was back in September, they expected another rate hike this year, which didn't materialize, and then only 2 rate cuts next year. And so they took off they took off a rate hike this year and then added in another cut next year. So overall, kind of like 100 basis points change in where they expect the Fed funds rate to end next year, which overall is a welcome sign. I think if you've been following us and you've been keeping track of how the Fed decides how they're going to guide interest rates for next year, it's really based on inflation. And so the fact that the Federal Reserve is saying, hey, we actually think interest rates will be lower at the end of next year versus what we thought prior, that tells you that the Fed is seeing some progress on inflation. That's a very good news.
For sure. And I kind of want to come back to that point, that word you mentioned about normalizing interest rates and saying right now we're at a point where interest rates are typically higher than where the Fed would want them to be, not at this normal level. But when we say normalize, I think I want to caution listeners or investors from thinking, okay, normal was what we had prior to all of these rate hikes. I would definitely say that interest rates were extremely low prior to I guess 2021. In a would you say like in a not normal way that they were artificially low for the last decade?
Yes. Yeah. I think there's really no question, right? If you look at a graph of the Fed funds rate, like you see it kind of go up a little bit and then sideways and it goes down. And that's kind of like, the Fed kind of tinkering with the economy by moving the Fed funds rate around. After the financial crisis, rates went to zero and they basically stayed at a flat line to zero. So the graph of the Fed funds rate kind of looks like a U, right? Where it's like it goes down and then it flattens out right at the bottom at zero. And then it went right back up really fast. And so now the Fed is going to have to unwind that. I think what we need to consider, and you make a good point, what does normalize mean to us? What would be a normal interest rate level? And the way a lot of us think about it is it depends on the normal rate of inflation in the economy. You essentially want the interest rates to match the level of inflation plus whatever level of expected real growth that you expect in the economy. So what the Fed ends up targeting is this real interest rate, where you take the nominal rate, whatever the Fed funds rate currently is, whatever that number is, you subtract off what inflation expectations are, and that gets you a kind of real interest rate. And so as inflation has been coming down, the real interest rate has been going up because nominal rates have stayed the same. Right, so that gap between nominal rates and inflation has started to widen, which means real interest rates have gone up. And so the Fed is instinctively saying, hey, this is putting strain on the economy that we need to pull back in order to not, do undue harm to the economy.
Yeah. And just providing a point of clarity there, real interest rates is just the interest rate minus what inflation is. And so if inflation's at 3% and the interest rate's at 4%, the real yield would actually just be 1%. And so that amount that you're able to get, the reason it's called real is because the cost of goods would be increasing with inflation. And so your real rate that you're actually returning is kind of that difference there, which is also very important to watch. But yeah, I mean, it's kind of hard to say what normal will be and what we will see. But I definitely think we're going to see rates be higher for longer. And that's something that is expected. Not necessarily at the levels we are now. We just mentioned how we're expecting some cuts there, but I don't think people are going to really shouldn't expect to see mortgage rates back between 2 to 3%. That was often a very irregular period that we sort of had there. I think we're going to find hopefully a healthy balance. Because I know a lot of economists say that our interest rates were unhealthily low. And that's not even a word, but they were just really, really low, which wasn't a great place for us to be in terms of stimulating the economy, because one of the ways to stimulate the economy is cutting rates. And so there wasn't much room to provide that stimulation going downwards. So all in all, we've had quite the roller coaster with this crazy inflation, rates spiking all the way up. And now us in 2024, hopefully bringing them back down, which can be a driving factor in sort of the economy. And hopefully we get to this rate that's much more sustainable and healthier for the economy. And we can talk kind of the recession and economy in terms of how we're going to react to that. But before we do that, I know we talked about sort of the Fed expectations of what the market rates would be, or the cuts would be. But I know the market is also pricing in cuts as well. And so there is sort of a difference there. You want to kind of touch on that, Jeff?
Yeah. So this is actually interesting because we talk a lot about how markets are forward looking, and a lot of people think of the stock market that way, but really it's investors that are that way. And investors are participating in all these different markets: equities, fixed income, currency, options, you name it, right? And so as soon as this new information is hitting the wires, investors are rushing to try to price this in. And so just like you're saying, and like we've talked about a lot, let's say that there are 3 rate cuts this year. Do we expect investors to price in 3 rate cuts? No, they almost never do that. They are almost always overzealous in pricing in the rate cuts. So what are we seeing right now in markets? They're trying to front run the Fed's own guidance on where they think rates should be. And so what's interesting is that if you look at the Fed, okay, we said 3 rate cuts next year. I'm looking at some probabilities that I looked up on the CME Fed watch tool to tell us what probabilities investors assign to different meetings for where the Fed funds rate is going to be after that meeting. And it looks like they are looking for 1, 2, 3, 4, 5, 6 rate cuts by the end of this year, right? So double where the Fed is at, and implying 150 basis points of lower rates by next year. Wow. I mean, you talk about investors coming in to like really rush in and price something and almost always overshoot. I think this is probably a good example.
What's the market targeting in terms of that final interest rate by the end of the year?
It's a range of 375 to 400 basis points, so 3.75% to 4%.
Where the Fed was at 4.6%. So there is a big misalignment there on basically what the market is pricing in versus what the Federal Reserve is saying. And so I know this has been a point that you've made, is that one of those obviously have to give. Either the Fed's going to cut more and be in line with what the market's expecting, or they're going to cut the same way that they've been projecting, and the market has to come back to that. I guess what would kind of be the implications if the market is overzealous in the way that, like, let's say the Fed is correct in terms of this is what they're projecting, this is exactly what they do. What would kind of be the impact on the markets there?
Yeah, so this is something that we saw earlier in 2023, where the market was expecting the Fed to be done raising rates or even cutting rates by the end of the year, and the Fed was trying to tell the market no, that's not what we expect. And eventually what you saw is those expectations had to be unwound. And what that looks like is rates moving higher. Because what happens is, a lot of people don't think about interest rates this way, but long-term interest rates, or kind of looking out over interest rates for a 1 year or 5 years or 10 years or 20-year period, they're really just an average of all the short-term interest rates in the interval period, right? And so if you think about the Fed funds rate, which is just a daily interest rate, 365 of those is going to get you an annual interest rate. 10 of those is going to get you a 10-year interest rate, and so on and so forth. And so when the economy, or when investors have to go back in and kind of unwind some of these expectations, it's not just affecting the Fed funds futures market. It's expecting it's impacting the treasury market. It's impacting equity markets with how discount rates are calibrated to value equities, which impacts credit markets and private equity markets and all kinds of things, right? And so that's what we saw in 2023, as during the summer equity prices fell and interest rates rose to kind of recalibrate those expectations. And then we kind of recalibrated them back. But hey, that's what makes a market. That's what makes it fun. That's why we rebalance often, is because these things can move around quite a bit, and they can move around substantially from where they should be, right? I mean, think about like where we expect the intrinsic value of, say, the market to be or interest rates to be. The market is almost never at that point. It's always wildly above or below it, because they're always kind of rushing to price in some of these expectations. So, we take advantage of that. We try to pay attention when the market is overzealous or sometimes, underestimating good news, which was somewhat the case, about 14 months ago.
Yeah.
Inflation, I would say.
So I guess to conclude here, it's going to be something that we're going to continue to watch in terms of where the Federal Reserve is with interest rates, how the market's pricing that in, and where we are as an overall economy. But if we haven't lost you yet, if you were able to stay engaged through all of our fun interest rate talk, we can kind of move down the docket. What's kind of another item you had on here, Jeff, that was interesting for you?
Okay, yeah. So one thing I really wanted to talk about was our population growth. This is something that we never talk about. We never really mention, because it's something that's slow and boring. And like, if it's 0.5% growth versus 1% growth, it's a huge change, right? And so this really doesn't get people excited. And it's one of those drivers of long-term economic growth that's never really going to see the light of day or get the recognition, right? But for people like us that really care about long-term macro trends and understand where the economy is going, it's pretty important. So the reason why I started looking at population growth was because we get these employment surveys that look really strong on the establishment survey, where the BLS goes and they ask different like factories and places of employment, and they say, hey, how many people did you hire? And they give them a number. And those numbers have been really strong, right? The labor market has been really strong. Well, then there's a different survey they do in that same report called the household survey, where they ask people, hey, how much did you work? Or are you looking for work? And in that survey, the labor market has not been quite as strong. We're actually seeing the number of unemployed people start to pick up in that survey, but the number of employed people is not falling. It's actually rising. And then I'm kind of looking at this economy like, okay, like we see interest rates that are high. The economy should be slowing. We see all kinds of economic indicators like consumer sentiment, small business optimism, that looks like the economy is doing poorly, but yet the economy continues to grow at a steady pace. Why is that? And it hit me like, we must be seeing some pretty decent population growth. There's so many people being added to the labor force that some are being absorbed into new workers, but the labor force is not quite strong enough to absorb all of it. And so we're seeing a rising unemployment rate, even though the number of people employed is growing. This is actually a very healthy dynamic for an economy, because we're actually adding to the labor force, right? Which is increasing the supply of labor, which is disinflationary. But a typical bad economic sign, a rising unemployment rate, is not happening because people are being laid off. It's happening because more and more people are out there joining the labor force and looking for work. It's just taking them a little bit of time to find that job. And so I pulled up population growth and I looked at it to see what it was. And I think if you look at this chart, and it's a chart that we have on here, it's the yellow line, Arish, looking at the year-over-year percentage change in the population. And it, trended lower. It peaked in, over the last couple of decades, peaked in the late 90s, and then really trended lower throughout the 2000s until about 2020, 2021, where the growth rate picked up. And actually, it's at a highest growth rate that it's been in 12 years right now, at just under 1.5%. I think it's like at 1.2% year-over-year growth, when really we've kind of been at that 0.5% growth rate over the past several years. To me, this was it. It was like, okay, no wonder the economy is growing so strongly, or it's kind of sticking around. It's not falling into recession. Some people have pulled back their spending. Some businesses have pulled back their spending habits and their hiring, but more and more people are being added to the economy and into the labor force. And guess what? More people existing means more houses that have to be bought, more services, more haircuts, more clothes, more food, et cetera, et cetera. It's just naturally good for economic growth. And so I thought this was a pretty interesting dynamic. And then one more piece I'll add here, the graph under, is looking at, okay, there's more people being added to the economy, but are those people earning income? Or are those people being accounted for if we look at economic growth on a per capita basis? And if you look at real, so inflation adjusted, real disposable income, this is income that people have after taxes, that per capita is still growing even with the population growth. So to me, it's like you look at some of these numbers and it's like, wow, no wonder the economy has held on for so long.
Yeah, I think that's a really interesting way to look at it, and not really something I'd considered in terms of the population. I think it's really interesting to look at this graph in terms of the year-over-year change in this population growth, and looking, like you mentioned, it kind of peaking around the late 90s, early 2000s here at about 2.5% or so, and then kind of steadies down and decreases, and now we're seeing it tick back upwards. But I think kind of a unique factor is right around that 1999-2000 period, where it peaked back up at 2.5%. A lot of those individuals are entering the workforce or looking for jobs. And so I think that kind of constitutes into that point of, okay, all of these new people are entering the workforce looking for jobs. And so that's why we're kind of seeing that increase on both sides, increase the people who are looking for work, but still seeing in employment at very healthy levels. And so that's a super interesting way of thinking about it. And I hadn't really considered that factor, but definitely a very important driving factor in terms of the health of our economy. And you would definitely agree that that is a healthy trend, that we are trending in this way, growing the population as we are.
Yeah, no doubt. And I think if you think back a year ago when we got those really strong labor reports and everybody was like, wow, like, are people really rejoining the labor force at this quick a pace?
Yeah.
And I think for us, it's like, oh no, they weren't. Like it was new people joining the labor force. And then, if you look on a 1 year basis now, what the effect of that has been, the number of employed and unemployed people on a 1 year basis are both higher. So, I mean, that's pretty, I know we talk about a lot how like, numbers matter and people can really use numbers to achieve a lot of different things depending on what their agenda is. But wow, that's two different things that you can point to make different cases on the economy. And to me, when looking at those in combination within that context, that's very, very healthy. And I think, again, disinflationary, which is very important.
Yeah.
Still,
Yeah.
I mean, keep in mind the Fed's expecting 3 rate cuts next year. If we want that, we're going to have to see inflation continue to come down. Inflation's not at their target yet. So I think that's a pretty interesting way to look at it, and something that, frankly, you don't hear a lot about because it's something that's, like I said before, it's not very sexy, right? But it's still important.
Yeah. Of course. I think it's a great point. And I think we have time to go over one more docket item here. If we have something. I know I see some stuff about the fiscal and monetary policy here. If you want.
Oh man, well, is that the one you want to choose? I mean, fiscal.
You can choose if you had something else.
Listen. Scroll all the way to the bottom here. Scroll all the way to the bottom.
All right.
I got a couple of charts.
Let's choose something
Tell me
more
which
fun.
one you. There's a chart that's looking at cross asset valuation of like small caps,
Okay.
international stocks, large cap stocks that tell a very, very interesting story that is contradictory to the narrative right now. We can talk about that, or we can talk about the table right under that shows the top 10 constituents of the S&P for the start of each decade here. And
let's do
that one. Okay.
Yeah,
so
yeah.
all right, so let's go through. Okay, so this is a chart. Like let's take one at 1980. At 1980, what were the top 10 most valuable companies in the world? And then it looks at what their 10-year returns are after that point. Right? So, hey, congratulations, IBM in 1980, you're the most valuable company in the world. What was your annualized return for the next 10 years? According to this, it was 10%. And the average for those top 10 stocks at 1980 was 12%. But the S&P 500 overall was 14% return over that 10-year period afterward. So the S&P still outperformed some of those top constituents. And if you look at it at 1990, at 2000, 2010, all of those top 10 companies at those times underperformed the S&P 500. And I think that's a really interesting thing to look at, considering that right now we have the highest concentration in the S&P 500 than we ever have historically. And the contributions of those companies to the total earnings pie is decreasing. And so, this is a very interesting dynamic where I know we've been talking about rebalancing a lot, making sure that you have a diversified portfolio that's not just the S&P 500. Well, I think this is a chart that lends a lot of credit to that theory.
Yeah, this is something that I've always really found interesting, and have seen this chart presented in many different ways. Looking at it globally like you have here, or looking at it just domestically in terms of who are the top 10 highest market caps in the S&P 500. And you look at it at the end of 1980, at the end of 1990, each decade. And I know I've heard a lot of dialogue around each of these saying, oh, these are the companies that are going to stick around forever. They're too big. They're too powerful. Nothing's really going to ever get in the way of these long-term success of these companies. And although we're bullish on a lot of these companies, we're not in the position that we want to be stock picking and saying, hey, we think this company is going to be the next biggest for the next decade or the next 2 decades after that. We want to own a piece of the entire economy. We want to own the biggest companies in the US, as well as internationally, as well as the middle size and small size. And so over time, the companies that do well are going to have a bigger ownership share in what we're owning. And I think that's a huge proponent for the way that we invest and the way that we're successful over time.
Yeah, I think completely. Yeah, we try not to pick individual stocks. There's a whole lot that can go wrong with that. I mean, even when you pick what you would consider like a good company, like a strong company, like you're saying, right? It doesn't mean that you can't overpay for it. And a lot of people make the mistake of thinking that picking stocks is just picking good companies or picking companies that are going to survive. No, it's about picking companies and buying them at a discount to their intrinsic value. Even buying Apple at $3 trillion would be overpaying, right? It's still just a $2 trillion company. And so I think that's one important note. Another thing is the themes of these top holdings really change over time. Like in the 1980s, I'm seeing a lot of Mobil, Schlumberger, Shell, Standard Oil, Exxon, a lot of oil names, right? A lot of oil names. If you look at 2020, I see one oil name at the top, Saudi Aramco. So I think that's interesting. It's also tough to know kind of what the new technology is going to be, or kind of what the new leading product is going to be. So like again, in 1980, you see like General Electric, a lot of appliances. Okay, that's good. Eastman Kodak, cameras, and then these were not digital cameras at the time. They were film cameras, right? And a lot of people thought, wow, like think of all the applications that cameras can have. And then, now we just carry one around in our pocket every day. So I think it's really interesting that we kind of have to understand that things change and that some things we can't predict. And so that's why we own a lot of different stuff. And if you're just going to own the top 10 companies in the S&P, that's typically not where you're going to outperform. It's tough for Apple to double when it's worth $2 trillion, but it's not tough for, say, CrowdStrike to double, or some other companies within that mid or small cap space that are trading at, $25 to $50 billion valuation. So I think that's very interesting.
Exactly. Yeah. It's hard for me not to make the point about proper diversification when looking at something like that. And I think that's so key to kind of how you're invested, and trying to take yourself out of just what the headlines are. We're always going to see the headlines of these top companies, how they're doing, their fluctuations year in, year out. But when we really, really zoom out, we see, okay, companies come in and come out that are these top performers in the S&P 500 or by total global market cap, like this is showing here, and wanting to make sure that you have that allocation to that throughout your retirement. You're not investing for the next year, 2 year, 3 year with your long-term money. That's for your retirement, which might be a little bit longer from now. And even if you're in retirement, we want that money to be invested well for your lifetime. So looking over decades of periods of time. So I think that's a really good point to make there.
Yeah. And hey, since you asked, Arish, you asked me to do one more quick one. I'm just imagining that in my head. This is kind of related to the other graph that I mentioned before about cross asset valuations. There's a kind of this theme in the market right now that things are really expensive, right? That like the stock market's expensive, everything's trading at high valuations. There's a lot of like earnings growth, and like certainly that's true for the S&P 500. But a lot of why that's true is because of those top 10 holdings of the S&P that are all mostly growth companies with high valuations and really high earnings expectations. If you look at literally every other asset class in the market, so just take everything else but the S&P 500, they're all trading below historical averages, and most are trading at substantial discounts, both relative to how they usually trade, but also relative to how they trade to large caps. So that includes small caps, mid caps, international, Japan. It includes some parts of emerging markets. So I think it's interesting to look back and say, okay, hey, sometimes the S&P 500, what's driving the performance can really change. And right now, it's all the rest of the stuff that's really, really cheap. So something to think about.
Yeah, I think that's a great point to make. I know I've definitely dealt with a lot of clients who say everything is so expensive right now. And yes, those top companies have driven up the valuations of the S&P 500 a ton, but that doesn't mean everything is expensive. There are a lot of value deals throughout the market, whether it's internationally or in emerging markets or in these middle and small companies. The Russell 2000, for example, I know has, I don't want to necessarily say underperformed, but in a way they kind of have underperformed. And
no, I think that's exactly what you should say.
Yeah. So they've underperformed, and that provides an opportunity with mean reversion coming back to the mean and looking at as an opportunity. They're much more attractively priced.
100%. I think when I look at some of our small cap strategies that we use, when I talk to the portfolio managers, go through some of those companies, what strikes me is that you don't have to own the S&P 500 or large cap growth or NVIDIA to participate in some of these long-term trends. NVIDIA has suppliers that are small caps. A lot of data centers or cloud infrastructure providers or digital technologies, a lot of these different industries and growing industries have different suppliers that are all in this small and mid cap index that are all going to participate, in that kind of rising tide lifts all boats mentality. So I think that's a way to play it, especially when it's, number one, cheaper. And, I think sometimes too, a more direct way to play that space.
Of course. Well, I know we kind of went over a lot. And so I hope this new format was beneficial, and our listeners were able to gain something from that. But Jeff, thanks as always for joining, providing your insights about what we're expecting for 2024. I know we'll have you on the podcast a couple more times to kind of talk about these updates and where we're at. Awesome. Yeah. Thanks for having me. I'm sure the listeners really appreciated the extra time there. You'll get it next time. Of course. Don't worry. There you go.
All information provided through this presentation is for educational purposes only and does not constitute investment, legal, or tax advice. It is not an offer to buy or sell any security or any insurance product. This is not an endorsement of any third party or such third party's views. The information contained herein has been obtained from sources we believe to be reliable and is not guaranteed as to its accuracy or completeness. Whenever there are references to third-party content, this information is intended to provide additional perspective and should not be construed as an endorsement of any services, products, guidance, individuals, or points of view outside Benedetti, Gooser & Associates and Beam Wealth Advisors. All examples are hypothetical and for illustrative purposes only. Benedetti, Gooser & Associates and Beam Wealth Advisors do not offer tax or legal advice. Interested parties are strongly encouraged to seek advice from qualified tax and/or legal experts regarding the best options for your particular circumstances.